there's only one way to completely avoid US tax, and that's by no longer being a US citizen. In this video, we're going to talk about expatriation, or renouncing your US citizenship, what that means, if you're going to be taxed on it, how the tax works, and who it really works for, and what do I recommend for people. If this type of content is useful for you and you're getting value out of these videos, please like and subscribe below. It helps me to create more content just like this for you. So I've been working with expats for over a decade, and a lot of times what comes up is expatriation, or renouncing your US citizenship, because at the end of the day, the US tax system is heavy in a lot of different ways. It can be expensive from a tax perspective, and it can also be expensive just administratively, just filing tax returns and getting the right advice. Or it can also be limiting in your ability to invest in your local or home country. So a lot of times I'm working with people, maybe you're an accidental American, someone that grew up completely outside the US, but you're a US citizen because maybe your parents are US citizens. You don't really have that same emotional connection to the US. That's a lot of times what I see when I talk to people about expatriation, but also some people that just are no longer interested in living in the US for some reason or another. Maybe they have some political bent. I've seen this on both sides. President Trump coming in and people wanting to leave. Biden coming in and people wanting to leave. So you always have both sides of the political side of it. And people actually do leave the US for political reasons, which is what I've found. There's all kinds of reasons to leave the US, but from my perspective, what I always tell people is that it's really a last resort, because at the end of the day, there are benefits of having a US passport. You can cover that benefit by getting other passports that are similarly useful from a travel perspective, but there's things you're giving up your US citizenship. So, I like to figure out what are the costs to you as an individual first, seeing if we can reduce that cost, whether it's a tax cost. Is there something we can do to structure your situation where it's not as heavy a tax cost for you to keep your citizenship, or a filing situation? Maybe your fees are too high. How do we simplify your structure so that it doesn't cost you so much to file every year? So that's usually the first step. But before we even get there, if you're liking this video, you should really check out my newsletter, where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. And in this video, we're going to talk about what it means to expatriate and what the implications of that are. And then we can talk a little bit more about who I think it works for in my experience most often. So when you leave the US, when you renounce your US citizenship, the IRS doesn't let you just get away scot-free. You have to potentially pay an exit tax. So what the exit tax is a mark-to-market taxation of all of your assets. So you take the value of all your assets today, and you take what you paid for it, and the difference between that is going to be taxable as capital gain or whatever it is today when you leave. So that's the basic idea. It is a little bit more complicated than that, depending on the type of asset you have. So for example, pensions are taxed a little different. They're taxed as if it was distributed today, and there can be withholding taxes. But the exit tax is your cost of renouncing. And that applies to you under one of three scenarios. One, you do not have 5 years of compliant tax returns. So this is where I get into this situation a lot with especially my accidental Americans, because maybe they just found out that they should have been filing tax returns all along. They now see that they're delinquent on a lot of years, and they just want out of the system. Well, unfortunately, to get out of the system, you need to get compliant with 5 years first to avoid that exit tax. So a lot of times, if you don't have most recent 5 years of tax returns filed and filed correctly and completely, then we're going to do that first. So you got to file those tax returns first, and then on that 6th year, you can expatriate and file that form. You got to have 5 years of tax returns to avoid the exit tax, number one. Or a better way to say it is not having 5 years of compliant tax returns will trigger the exit tax in and of itself. The second way you trigger the exit tax, the term for this is a covered expatriate. If you see that online, or if you're reading about this, when I say triggering the exit tax, I mean that you are considered a covered expatriate. So one way to be a covered expatriate, like I said, is not having 5 years of returns. The second way is if your tax liability was over a certain amount over the last 3 years on average. It's over 120,000 or so of average income tax liability over the last 3 years. It's pretty high. Again, that's not your income, that's the tax liability on your return. So a lot of times that's not going to be applicable for a lot of people. The third way you can be considered a covered expat or trigger the exit tax is if your value, the value of all your assets on the day before you expatriate expatriate is more than 2 million US dollars. So that's the one that gives people the most problems, right? Especially, depending on your age and how long you've been working, if you take into account values of homes, retirement accounts, bank accounts, all those things can add up to 2 million pretty quickly. And so if you're over that 2 million, it triggers this exit tax, which is usually what, from a planning perspective, we're trying to plan around. How do we get under that 2 million prior to expatriating? So that's what you'd hire somebody for. If you wanted to do some planning around expatriation, is looking at that 2 million mark usually, or filing the tax returns like we said before to get that 5-year certification. If you meet one of these and you're a covered expat, now we have to do a calculation to figure out what that exit tax looks like. So just because you're subject to the exit tax doesn't mean it's that big of a deal necessarily. Because what if you have assets that don't have a lot of gain associated with them? So it may not be that big of a fight at the end of the day, but you have to get somebody to calculate that for you to see what your worst case scenario is. And again, depending on the asset type, it can be a different situation. So pensions are going to be taxed one way, homes are going to be taxed another. There's actually an exemption of about $800,000 for mark-to-market type assets. So a home or an investment account, that's going to have an $800,000 exemption. So those are the only assets you have, and the gain's not that big. So then maybe it's not that big a deal to be a covered expat. You have to be a little careful too with foreign assets because they have their own complications and situations to live in. That would be part of what you're getting into if you're a covered expat, is you're going to need a professional to walk you through that calculation and how to navigate it in the best way that's possible for you. So once you've figured out if you're subject to the exit tax or not, another thing you're going to want to look at is what does it mean after you expatriate? So now you've done it, you're a non-resident. What is your obligation to the US going forward? I had one client, for example, that maybe we could have done some things to limit his exposure to the exit tax, but all of his income comes from US partnerships. So that's US businesses spitting off income effectively connected with those US businesses. So now the partnerships, if he's a non-resident, have to withhold at 37% on his partnership income. So he's still paying US taxes on all of his income, even though he's renounced. So in his case, it really didn't make sense without setting up some super complicated structure or changing the way he's invested in these US partnerships. Even if you can minimize the exit tax liability, then have to look at what's your tax going forward. And as a non-resident, you're taxed on your US sourced income or income from a US trader business. So you have to look at that. What US source income are you leaving behind? Because you're still going to have US tax responsibilities potentially for that US income. And it's going to be different depending on whether you've moved to a treaty country or a non-treaty country. So that's kind of your next step of looking at the impact. So a couple typical examples. I deal with a lot of the accidental Americans, with those people that don't have a strong connection to the US. Maybe they don't even have any family in the US. They're just having to pay these high taxes, high fees, and more importantly, the limitation on their investment opportunities, because there can be big implications for investing in certain things. Say if you're in the UK, investing in foreign mutual funds or retirement plans, the IRS starts taxing that stuff and it's not being taxed in your local country, which is just blatantly unfair, but at least it's triggering additional taxes. I can understand where that's hard for someone to stomach as a non-American. So a lot of times that's where I see expatriation, or maybe someone that grew up overseas, moved to the US and is now leaving. Another thing you have to keep in mind is expatriation doesn't just apply to US citizens. It also applies to US green card holders if you've held that green card for 8 out of the last 15 years. And importantly, 1 year includes any year in which you spent a day as a green card holder. So that could include technically 6 years and 2 days if you got it December 31st of 1 year and you gave it up January 1 of the last year. So be careful with that rule because you could accidentally fall into these exit tax rules as a US green card holder. But the general rule is, from my perspective, when you're looking at renouncing, is the last case resort. Let's look at what your situation is today. What are the negatives of having that US citizenship? What are the costs? How can we reduce those costs? How can we reduce your taxes, restructure to simplify your overall filing requirements? And then if all of that is still too burdensome and it doesn't make sense for you to have your citizenship, then we look into renouncing and look at the exit tax costs and your tax costs going forward with any US source income. So if you're considering renouncing your US citizenship, or maybe you've been living outside the US for a long time and you're wondering, is this really worth it? What would it really mean if I did renounce my US citizenship? What are the costs for that? Reach out to us at McGowanTax.com. I'm happy to have a consultation with you personally to look at your situation and find out what's the best methodology for you and what would work best for you. If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.